Hello, welcome back to Accounting 102. We're going to cover Chapter 10, Budgetary Control and Responsibility Accounting. Learning objectives, we're going to describe budgetary control and static budget reports, prepare flexible budget reports, apply responsibility accounting to cost and profit centers, evaluate performance in investment centers, and then there's a fifth one that we will cover as well that's not in this outline, but it's in this deck, and we will cover it at the end, looking at return on investment and some options for that. So let's get into the material. The use of budgets in controlling operations is known as budgetary control. So the budget reports, they'll compare actual results with planned objectives. So we learned about building a budget. You then compare that against actual to get some reports that show where you were better than budget or on budget or worse than budget. So it provides management with feedback on operations. Budget reports are prepared as frequently as needed. Management analyzes the difference between actual and planned results and determine causes. Okay, so my experience is definitely monthly. You're going to look at the whole organization of what the budget for the month versus your actual results and explain the differences. We'll get into flexible budgets a little bit later and how that impacts kind of what you're looking at. But then the lower you go in the organization, the more frequently you're going to look at results. So factory might be looking at production weekly to be able to make changes within the month, not waiting till the month end, and that type of thing. And here's kind of a graphic of what it looks like. Starting with upper left, we're going to develop the budget. Then we'll have actuals, and we'll analyze differences between actual and budget. Then we'll take corrective actions against that, depending on what the results are. Modify our future plans, which will then feed into developing hopefully better budgets. And then that cycle just continues. Budgetary control works best when a company has a formalized reporting system. So identifies the name of the budget report. So as most reports that we've seen in 101 and now 102 is you have to have a title with the name of the report, states the frequency of the report, the specific purpose of the report, and indicates the primary recipients of the reports. Here's examples of different types of reports, what the frequency is, what the purpose is, and the primary recipients. So sales, labor, weekly reports. For the sales, you're looking at whether the sales goals are met for the week, things that you may have to do to improve sales, or whether you don't have to push as much if your sales are going well. And it's top management and sales manager. Labor, you're controlling direct and indirect labor costs, and that's saying that it's the vice president of production and production department managers. Some things that are even daily. Then you get into overhead costs, selling expenses, income statement are more monthly reports. And then even the income statement is quarterly as well. Quick review question. Budgetary control involves all but one of the following. And the answer here is using static budgets. So we talked about modifying future plans, analyzing the differences, determining the difference between actual and planned results. We haven't talked about static budgets, which we'll do on the next slide. So a static budget is a projection of budget data at a single level of activity. So when we talked about developing budgets, prior chapters, we talked about doing an annual budget, for example, and maybe dividing that into months. You're going to do that once a year, like we talked about in Chapter 9. You know, I've seen it where you start in July, August timeframe. You've got some reviews in the fall, maybe finalizing November, December with some potential even you know, end of year adjustments after you close the books in January for the fiscal year, and then that's your budget for the year. That's a static budget. It's not going to change. You're going to be measured on that. A lot of uh, incentives are based on that budget. Um, but then what you're going to do each month, for an example, is you're going to have forecast, or you're going to recast what it would look like with the new information that you have. That's more like a flexible budget that we're going to talk about. So when using budgetary control, each budget included in the master budget is considered to be static. It ignores data for different levels of activity. So we're saying we're going to sell X, and that means we need to produce Y to be able to sell X and get the right inventory levels, and nothing changes. And then we'll compare the actual results with that budget data at the activity used in the master budget. So if you sell more or less, you're going to have some variances there. You have to do some investigations on why, and then how does the cost follow that new level of activity. So right ride, continuation of what we saw last chapter. Budget and actual sales data for right ride product in the first and second quarters of 2027 are as follows. So we have first quarter budgeted sales and actual sales with the difference. Same for the second quarter, and then the total or the year-to-date amount. When we look at kind of a budget report, sales budget report in this case, we have the budget column, we have the actual column, and then a difference column with it's either going to be favorable or unfavorable with the F or the U. Okay, I've also seen reports where it doesn't have the F and the U, like we're going to see in this chapter and some of the examples we go through, but you know, positive is favorable, negative is unfavorable. So this would be as a minus 1,000. So you might run across those types of reports in difference columns as you're working. So this is for the first quarter. If we did it for the second quarter, we would see the first three columns is for the second quarter itself, using that data, and then the year to date, the next three columns are the actual total that we saw earlier. So year to date meaning we're adding up the first and second quarter. If we did year to date at the end of September and the third quarter, we would have 3 quarters worth of data there. It's just the total for the year. So some uses and limitations of static budget reports. It's appropriate for evaluating managers' effectiveness in controlling cost when actual level activity closely approximates master budget activity, and or the behavior of costs is fixed in response to changes in activity. It's appropriate for fixed costs, not appropriate for variable costs. So what we're saying is if our actual activity is in line with our budgeted activity, not much differences, then it's appropriate to use the static budget. If there's a wide swing in activity, it may not be the best tool, the best report to use. If behavior of cost is fixed, so the relevant range that we're talking about, the costs are more fixed than variable, then it's appropriate. And of course, if it's just fixed costs, it is. But most variable costs change with activity levels, so the budget's going to be stuck on one activity level, your actual is going to be a different activity level. So you're going to see variances that are caused by the activity level, not necessarily did I control my cost and manage the business appropriately. Another review question. Static budget is useful in controlling costs when cost behavior is A, mixed, B, fixed, C, variable, or D, linear. We just talked about this. It's when it's fixed. So let's look at another problem here. Lawler Company expects to produce 5,000 units of a product CV93 during the current month. Budgeted variable manufacturing costs per unit are direct materials $6, direct labor $15, overhead $24. Our monthly budgeted fixed manufacturing overhead costs are $10,000 for depreciation and $5,000 for supervision. In the current month, Lawler actually produced 5,500 units. Direct materials were 33,900. Direct labor, 74,200. Variable overhead, 120,500. Depreciation, 10,000, and supervision, 5,000. Prepare a static budget report. So what we would do is we're going to create a budget report. We'll have a budget column and an actual column, and then the difference column. So we'll start with units. Budget's going to be 5,000 units. Actual is going to be 5,500 units. We'll have our variable costs. We have the cost per unit for the budget that we'll multiply by 5,000 to get the dollars. Compare that to the dollars of our actuals. And then our fixed costs. We don't have per units, we just have total fixed costs, and we'll show that as well. So here's what it looks like. The budget on the left there, 5,000 units. We have our variable costs per unit, so we multiply those. And so each line we have unfavorable and favorable variances for our variable costs, but using a static, a lot of it looks unfavorable, even though we produced 10% more than we budgeted for. So 5,500 actual versus 5,000. We produced more. You would expect your variable costs to increase since they're variable based on activity. So this is an example of a static budget report. And if you're trying to understand, did I control my costs against the budgeted, a per unit or a flexible budget would be a better way to do that. But companies use these, and you need to understand how they're put together and what the benefits and limitations are. Now we'll look at flexible budgets. A flexible budget projects budget data for various levels of activity. Essentially, it's a series of static budgets at different activity levels. The budgetary process is more useful if it is adaptable to changes in operating conditions and can be prepared for each type of budget in the master budget. So what we're going to be doing is changing our activity levels and basically doing budgets for those different activity levels. Now we'll see in some examples we don't have to do it up front. We're going to show how that might happen up front, but you can always go back to when you have your actuals, what would my budget look like if I had budgeted that actual activity? And then you can compare that, and that'll give you some useful information. So Barton Robotics static overhead budget. So we have that we're going to produce 10,000 units. Here's our cost for our different categories: indirect materials, indirect labor, utilities, depreciation, property tax, or supervision. The manufacturing overhead static budget report assumes 12,000 units were actually produced rather than 10,000. So we actually produced 2,000 more than we had budgeted for. So we have unfavorable variances in our variable costs, which makes sense because it's a variable cost, so it's going to increase with increase in activity. So as we increase that activity, the cost will increase. So it looks like we didn't do very well because we are unfavorable. So we're over budget in 3 of 6 overhead categories, 12% over budget, but our budget data for 10,000 units is not relevant. It's meaningless to compare actual variable costs for 12,000 units with budgeted variable costs for 10,000. Again, variable costs increase with production increases. So if you're comparing a static, it's not very useful. But if we look at our budget, break it down to the unit variable costs. So we take our budgeted costs for those categories, divided by the number of budgeted units, 10,000, we get our unit variable cost. Then if we apply that unit variable cost to our 10,000 units actually produced, we see here's what our budget would have been if we would have budgeted 12,000 units. Okay, so we're flexing our budget so we can change the activity and recast what that is. We can then compare that to actuals, and you can see that we're actually favorable in variable costs. Indirect labor was right on budget, so the same per unit cost for budget and actual. Indirect materials was favorable 5,000, utilities was favorable 3,000. So we're actually favorable 8,000 at the same level of activity. Okay, we're unfavorable and are static, but we produced more than we had anticipated, than we had budgeted for. So we are unfavorable because of that. When you look at it on a more apples to apples basis at the same activity level, in this case, we were actually favorable. We did a good job controlling our costs. When we develop a flexible budget, we're going to identify the activity index and relevant range of activity, identify variable cost and determine a budgeted variable cost per unit of activity for each cost, identify fixed costs and determine a budgeted amount for each cost. So these are things that we've seen in previous chapters. What's the activity, what's the driver of our costs, what's our relevant range. So we're not going to have an infinite number of budgets or flexible budgets. We're going to have a relevant range that makes sense. And then break out what's variable and what's fixed. And then prepare a budget for selected increments of activity within that relevant range. So Fox Company, we use a flexible budget for monthly comparisons of actual and budgeted manufacturing overhead costs in the finishing department. The master budget for the year ended December 31st, 2027 shows expected annual operating capacity of 120,000 direct labor hours and the following overhead costs. So we have our variable and our fixed costs. We are going to use 120,000 direct labor hours as our activity, and we're going to create a flexible budget. So there's 4 steps in developing a flexible budget. First, we identify the activity index and relevant range of activity. In this example, direct labor hours is our activity index, and the relevant range is 8,000 to 12,000 direct labor hours per month. Next, we'll identify the variable costs and determine budgeted variable cost per unit of activity for each cost. So we take our budgeted costs that we saw in that budget report, divided by the 120,000 direct labor hours, and we get a variable cost per direct labor hour. The fixed costs, we're going to look at these and determine the budgeted amount for each cost. So we're going to look at it per month budget. So we're going to take the annual amounts that was in the report for depreciation, supervision, and property taxes, simply divide it by 12 to get the per month amount. And then the last step is prepare a budget for selected increments of activity within the relevant range. Remember, we said the relevant range was 8,000 to 12,000 direct labor hours. So we're going to prepare these in increments of 1,000 direct labor hours. So here's what that would look like. It's the monthly manufacturing overhead flexible budget. We start at 8,000 direct labor hours, and we'll do it for 9,000, 10,000, 11,000, and 12,000. We take that number of direct labor hours times our variable costs. So indirect materials $1.50, indirect labor $2, utilities 50 cents. We just multiply that by the direct labor hours in each column, and we get our variable costs for each level of activity. Since we're doing monthly budgets, we take the monthly amounts for fixed costs. That's going to be the same regardless of the activity level. So that's why you see the same numbers repeated in each of the columns, because fixed costs do not change with changes in activity level. Now our cost equation for total budgeted costs is fixed costs plus variable costs is the total budgeted costs. That makes sense. Our variable cost then is the level of activity, in our case, number of direct labor hours times the variable cost per unit of activity. We had 3 different variable costs that we saw. The total is $4 per direct labor hour. So at 9,000 direct labor hours, we saw from the chart, we had 30,000 of fixed costs plus $4 times 9,000 was 66,000. If we had 8,622 direct labor hours, the budget would be the $30,000 in fixed costs plus 8,622 direct labor hours times $4 per hour. So the total will be 64,488. If we look graphically at what this looks like, we can see at the bottom here is our fixed costs. It's 30,000 per month. So regardless of the changes in direct labor hours going across the bottom, we're at 30,000. As we increase our direct labor hours, we're increasing our variable costs, which increases our total costs. So at 10,000 units of activity, so 10,000 direct labor hours, if we go up to this top line and go across, our costs are $70,000. If we increase to 12,000, we go up to the blue line. It's almost 80,000, not quite 80,000 at 12,000 direct labor hours. So that's how you would read the graph. So talking a little bit more about flexible budget reports. It's an internal report. It has production data for selected activity index, such as direct labor hours in our example that we've been using. Then it has cost data for variable and fixed costs. It's widely used in production and service departments to evaluate a manager's performance. So we're looking at the different levels of activity and kind of trying to get in line what would the budget be at the level of activity that our actuals are at, and did the manager and the department control their costs at that level of activity. So here's an example. Again, this is for the finishing department. The budget at 9,000 direct labor hours, so using 9,000 direct labor hours as the activity driver for the budget, what our budget would be. And then we have our actual costs, since we incurred 9,000 direct labor hours in total. We just drop in those costs. We see in the variable we have a couple of unfavorable, one favorable. Overall, our variable costs are favorable. Fixed costs are fixed, so no changes there, no variances. So we were $400 favorable at that level of activity. So another review question. At 9,000 direct labor hours, the flexible budget for indirect materials is 27,000. If 28,000 of indirect materials are incurred at 9,200 direct labor hours, the flexible budget report should show the following difference for indirect materials. So indirect materials is budgeted at $27,000 at 9,000 direct labor hours. Our actuals were 28,000, and our actual direct labor hours was 9,200. If we do a flexible budget, we're going to change the budget. Okay, so first we have to look at what our per direct labor hour budget was. So that 27,000 divided by 9,000. Our flexible budget then is that $3 per direct labor hour times our actual direct labor hours, 9,200. We get 27,600 is our flexible budget at 9,200 direct labor hours. Now we can compare that budget to our actuals to determine if we're favorable or unfavorable. Our actuals were 28,000. The budget says we should be at 27,600. So the difference of 400, we should be, we're 400 unfavorable for indirect materials. Now we'll do another example. In Strassel Company's flexible budget graph, the fixed cost line and the total budgeted cost line intersect the vertical axis at $36,000. So we're talking about this orange line here, straight across, this diagonal blue line, they intersect here at $36,000. Budgeted cost line is $186,000 at an activity of 50,000 direct labor hours. So if we go over to 50,000 direct labor hours across the bottom, go up to that line, which is the total costs, and go across, it's at 186,000. Question is, what is the total budgeted costs at 30,000 direct labor hours? So moving to the left here to 30,000, if we go up, intersect that line at the right spot and go over, what is our total cost? So let's walk through how we do that. First, we're going to figure out what our variable costs are. At 50,000 hours, we had total costs of 186,000. Our fixed costs were 36,000. That was that straight line going across. That's where the intersect was, 36,000. So that's our fixed costs. So our variable costs were 150,000. Then we can figure out our variable cost per direct labor hour by dividing our $150,000 variable cost by our activity level, $50,000 or 50,000 hours, $3 per direct labor hour. We want the budget now at 30,000 hours, so we're going to multiply our variable costs per hour times our new activity level, 30,000 hours. We get $90,000 of total variable costs. We then have to add back our fixed costs to get a total cost, and the total budgeted costs are $126,000. Learning objective 3 is apply responsibility accounting to cost and profit centers. So accumulating and reporting costs and revenues on basis of the manager who makes decisions about the items. So we're going to, instead of taking the company's financial statements or cost reports, income statement, we're going to break it down to the level where management can make decisions about the items that are on that report. So its costs and revenues can be directly associated with a specific level of management responsibility. Costs and revenues can be controlled by employees at level of responsibility with which they are associated. Budget data can be developed for evaluating the manager's effectiveness in controlling costs and revenues. So if we have that, we can have responsibility accounting and responsibility center reporting. So here's a graphic, Wisconsin Cheese Company. We have department manager, I'm responsible for controlling costs in my department. The division manager, she's responsible for controlling costs in her division. And the president, the big cheese, responsible for controlling company costs. So with responsibility accounting, we can get reports and information at each of these different levels where the manager can then make decisions and they're responsible for the costs at that level. Some terms we're going to be talking about: responsibility center. It's any individual who has control and is accountable for activities. Makes sense to any level of management. It's especially valuable in a decentralized company where control of the operations is delegated to many managers throughout the organization. You don't have a central area that makes all the decisions. In a segment is an area of responsibility for which reports are prepared. Some couple of differences from budgeting for cost and revenues. We're going to look at controllable and non-controllable items. Okay. It emphasizes or includes only items controllable by the individual manager and performance reports. So if there's costs that are not controllable by the manager, we're not going to put them in their responsibility reporting. Okay, it's only costs that they can control and have an impact on changing, both positive and negatively, and that's what's going to be in the report. So this applies for both for-profit and not-for-profit entities. With for-profit entities, we're going to try and maximize net income. For not-for-profit organizations, we're going to minimize the cost of providing services. Now, we said we're going to distinguish between controllable and non-controllable items. So what exactly are those? A cost over which a manager has control is called a controllable cost. All costs are controllable by top management. So the president, CEO, board of directors, they control everything. Fewer costs are controllable as one moves down to each lower level of managerial responsibility. Costs incurred indirectly and allocated to a responsibility level are non-controllable costs. So sometimes you'll have costs that are allocated to different departments or different plants or different parts of the organization. Those allocated costs are not controllable. You're just something that has to be on the report. So IT is a good example of a allocated cost in a lot of companies where you have a central group that manages the IT systems. They make decisions on buying software, which, is it an on-premise server or do we use a cloud-based system, that type of thing. The individual departments and manufacturing plants that use those services and software don't have as big of an impact or direct impact on controlling those costs. They just take an allocation from that central location. So that would be a non-controllable cost, and that wouldn't show up on a responsibility accounting or a responsibility report. Management function that compares actual results with budgeted totals includes both behavioral and reporting principles. So this is principles of performance evaluation, evaluating the management. Management by exception means that top management's review of a budget report is focused primarily on differences between actual results and planned objectives. A couple things to keep in mind is materiality. So without a quantitative guidelines, management would have to investigate every budget difference regardless of the amount. So you may set a materiality, either a dollar figure, so any variance over $5,000 you need to investigate, or a percentage, any variance that's 3%, 5% off its budgeted amount or expected amount, then you would investigate that. Auditors use this a lot when they're asking about changes in costs or spending year over year. They would set an example and say, all right, I wanted explanations for all these line items that are over 10% difference. So I don't have to go through the whole P&L account by account to explain every difference. I can only I only explain the ones that are materially different. Then the other thing to look at is the controllability of the item. Exception guidelines are more restrictive for controllable items than for items the manager can control. So if I run a department, my department's wages and salaries, direct labor, indirect labor, whatever it is, I can control that because I set those pay scales. So that's a controllable item. If it's an allocation or something else that I can't control, then it shouldn't be on my report because it's just an amount that it showed up. And if it's a variance to that, I haven't directly impacted or controlled why there's a variance. Some behavioral principles. Managers of responsibility centers should have direct input in the process of establishing budget goals of their responsibility area. So we talked about this in effective budgeting. You get buy-in and input from different levels of activity. So definitely, if you're going to have a responsibility center and measure people on that level of activity, they should be involved in setting the budget. Evaluation of performance should be based entirely on manners that are controllable by the manager being evaluated. Again, if it's not controllable, someone else causes excess spending, that manager that didn't make that decision shouldn't be held accountable. Top management should support the evaluation process. As with most things in a business, if top management doesn't support it and stand behind it, it's not going to be very effective for the organization. Evaluation process must allow managers to respond to their evaluations. So if there's an evaluation and they are looking like it's not a very good job of controlling costs, the manager should have a chance to respond to that and explain what happened and why it happened. An evaluation should identify both good and poor performance. So a lot of times when we talk about these evaluations and variances to budget, we talk about the bad side, that you had more costs, that type of thing. But if you're controlling costs and you're spending less than your budgeted amount, that should be identified as well and rewarded. Some reporting principles. Again, it seems like we're repeating this a lot, but it's very important. It should contain only data that are controllable by manager of responsibility center. So non-controllable costs shouldn't be included because it's meaningless. It should provide accurate and reliable budget data to measure performance. The reporting should highlight significant differences between the actual results and budget goals. It should be tailor-made for intended evaluation by ensuring it's only controllable costs are included. So different departments are going to have different looking reports because the controllable costs are different. And be prepared at reasonable time intervals. Preparation of report for each level of responsibility in company's organization chart begins with the lowest level of responsibility and moves upward to each higher level. Permits management by exception at each level of responsibility. Each higher level can obtain the detailed report for each lower level of responsibility. So let's look at this a little bit graphically to see what we're talking about. So at the bottom, report D, we've got the different departments: fabricating, assembling, and enameling. That rolls up into a factory. So in this case, these all roll up to a Chicago factory. The Detroit factory and the St. Louis factory will have similar reports for those different departments, assuming they make the same type of things. There could be different things going in those factories, so they'll have different departments, but it all rolls up to a factory level. Then the three factory reports, they can do exception based, so there'll be more costs that are controllable at the factory level, for the factory manager than a department manager in their individual department. That will go into the vice president of production, who's going to look across all of the factories, but then can also drill into each individual factory and in the departments. They'll have similar things for sales and finance. And then the president will see all of the reports from their VPs and then can drill down into all the factories and the different departments. Now, if we look at the actual reports, we're going to start with A and B. So report A is the president level. So they've got their vice presidents listed, sales, production, and finance that we looked at, and they see all those and what's favorable and unfavorable. For the production vice president, that one line item that the president sees, they're actually made up of the different factories plus the vice president of production department itself. So you can see where that total on report B is the line item in report A. If we drill down to report C then, the Chicago factory is highlighted there in report B. That comes from the total of the report C, which is the factory manager report for Chicago. It's got their different departments. And go down to report D again. That total for fabricating and report C is made up of the items that the fabricating department manager can control: direct materials, direct labor, and overhead. So that's how you can drill down, and at the same way, going backwards, summarize up into different levels. So the responsibility reporting center or system permits comparative evaluations. Plant managers can rank each department manager's effectiveness in controlling manufacturing costs. A comparative rankings provide incentive for manager control costs. So if they know they're going to be looking, be compared to other department managers on how will they control costs, they may have more incentive to actually do that because they don't want to be at the bottom of the list. There's three types of responsibility centers: cost center, profit center, and investment center. A cost center incurs costs, does not directly generate revenues. Okay. Managers have authority to incur costs. Managers are evaluated on the ability to control those costs. It's usually a production or service department. So there's no control over making sales. They're just either supporting another department, supporting the sales team, or actually producing something in a department. A profit center, it incurs costs and also generates revenues. So the manager are judged on the profitability of the center. So some examples are individual departments of a retail store, a branch bank office. Okay, it could be an individual factory. When we left the example we looked at before, if they are having sales directly from that factory, then that could be a profit center. Then an investment center incurs costs, generate revenues, and has investment funds available for use. A manager is evaluated on profitability and the rate of return of earned funds, and often it's a subsidiary company or a product line. So it may be a group of factories that are grouped together, so it's a subsidiary of a bigger company. Could be a product line. So, something that a rubber company could be automobile tires versus truck tires versus bicycle tires, for example. So that could be a different product lines, and those could be investment centers because they're going to have different investments, different um, types of machines and factories needed to make those different products. And here's graphically the different centers. Cost center is just expenses, they're spending money. Profit center, they have expenses, but they also have revenues. And the investment center then also has the ability to invest, and a return on investment can be done against them. Another review question. Under responsibility accounting, the evaluation of a manager's performance is based on matters that the manager A, directly controls, B, directly and indirectly controls, C, only indirectly controls, or D, has shared responsibility for with another manager. So responsibility accounting is directly controlling costs. So it's only the things that are controllable. So if we look at responsibility accounting for cost centers, it's based on a manager's ability to meet budgeted goals for controllable costs. Results in responsibility reports which compare actual controllable costs with flexible budget data. We include only controllable costs in the reports, and there's no distinction between variable and fixed costs. So we're just looking at what's variable or what's controllable and what's not controllable versus variable and fixed. So here's an example for the Fox company. We have flexible budget for the finishing department. The costs that are controllable are the only ones that we can look at or should be looking at in the responsibility report. If you look at supervision, 4,000 budget, 4,000 actual. So the finishing department manager is able to control all manufacturing overhead costs except depreciation, property taxes, and his own monthly salary of $6,000. So what's on the report is the remaining 4,000. So 10,000 was the supervision cost we saw in an earlier slide. We're going to take out the 6,000 of the finishing department manager's salary. 4,000 is remaining. The remaining of supervision costs are assumed to apply to other supervisory personnel within the finishing department whose salaries are controllable by the manager. So it's not only just the line items, we're actually breaking up the data within a line item to only put the controllable costs in. If you look at profit centers, it's based on detailed information about both controllable revenues and controllable costs. Manager controls operating revenues earned, such as sales, and the manager controls all variable costs incurred by the center because they vary with sales. Direct fixed costs relate specifically to one responsibility center, incurred for the sole benefit of that center. It's also called traceable costs since they can be traced directly to one center. Most direct fixed costs are controllable by profit center manager. Indirect fixed costs pertain to a company's overall operating activities. It's incurred for the benefit of one or more profit center. They're called common costs since they apply to more than one center. Most are not controllable by the profit center manager. So these indirect costs aren't controllable. They wouldn't be on that level of reporting. Budgeted and actual controllable revenues and costs uses cost, volume, profit, income statement format. So we'll deduct controllable fixed costs from contribution margin. Controllable margin is the excess of contribution margin over controllable fixed costs. Non-controllable fixed costs are not reported. Okay, so we're going to have contribution margin like we saw in the cost, volume, profit, income statement format, and then our controllable fixed costs will give us our controllable margin, and this is what a report might look like. So we have our sales, our variable costs, which give us our contribution margin, and then our controllable fixed costs, both cost of goods sold and selling and administrative, gives us our controllable margin. This report does not show non-controllable fixed costs of $60,000. These costs would be included in a report on the profitability of the profit center. In a responsibility report for a profit center, controllable fixed costs are deducted from contribution margin to show the profit center margin, the controllable margin, net income, or income from operations. We just looked at, it's the controllable margin. Let's go through another problem. Midwest Division operates as a profit center. It reports the following for the year. We have budget and actual for sales, variable cost, controllable fixed, and non-controllable fixed. We need to prepare the responsibility report for the Midwest Division for December 31st, 2027. So we're going to have the two columns, budget and actual. We'll have a variance column or difference column, indicate whether it's favorable or unfavorable. The items that we will include on the report are sales, all of our variable costs, which will give us our contribution margin. Then what do we subtract from the contribution margin? That would be our controllable fixed costs to give us our controllable margin. Now we'll evaluate performance in investment centers. We looked at cost centers. We're just looking at the costs that they can control, and if they using flexible budgets to see if they manage their costs well. The profit center, we can go down to a controllable margin where we have only controllable fixed costs included, and we're excluding non-controllable fixed costs. Now in an investment center, we're going to use return on investment as the primary basis for evaluating the performance of a manager in an investment center. It shows the effectiveness of a manager in using assets at his or her disposal. Factors in ROI calculation are controllable by the manager. So the formula for return on investment is controllable margin divided by average operating assets. That gets us our return on investment. So if we had $1 million of margin, our average operating assets were $5 million, we say we have a 20% return on our investment. Operating assets include current assets and planned assets used in operations by the center and controlled by the manager. Base average operating assets and beginning and ending cost or book value of assets. So we're just going to take a simple average of beginning of the period, the end of the period. We can either use the book value or the cost. Book value makes sense because that's what's on the financial statements. And you just take a simple average there to get to our average operating assets. The scope of a manager's responsibility affects content. The investment center is an independent entity for operating purposes. All fixed costs are controllable by the center manager. Shows budgeted and actual return on investment below controllable margin. So here's an example of that kind of report. We have our budget and our actual, and then our difference. We have sales, then our variable costs to get contribution margin. We have controllable fixed costs, controllable margin, and then our return on investment. So it's a couple things that we've looked at or that are different than what we looked at before is that other fixed costs that's highlighted there, row 17. That's $60,000 of fixed costs that we talked about that wasn't included in that report before, now is included because we're at the investment center level, another level up that is controllable for them. And then we have our return on investment, which is simply the controllable margin divided by the average operating assets. Some alternative measures of ROI inputs. The valuation of operating assets. We talked about cost and book value. So those could, either of those could be used. You could also use appraised value or fair value. Each one of these provides a reliable basis for evaluating performance. The key is that you're consistent, that your budget and your actual are using the same valuation, and if you're looking year over year, that you're using the same method so you can compare them. It wouldn't be right to use acquisition cost one year, fair value the next year, and have those be widely different amounts because you couldn't compare those. It wouldn't make sense of what your comparison is. The margin or income measure. So we use controllable margin on our example. You could also use income from operations or net income. Again, depending on what level of the organization you're in, net income makes sense at the company-wide level, may not make sense at a division or a segment level because there could be things that are controlled at the corporate level, for example, interest in income taxes, that type of thing. So it's only controllable margin is a valid basis for evaluating performance of a manager. So again, what does that manager control? That's the best measure. In order to improve ROI, there's two ways we can do it. We can increase our controllable margin or reduce average operating assets. Those are the two ways. Those are the two numbers that are in the calculation. And then it's also the two numbers that are going to change if you're looking at different scenarios. So we'll see some examples of that. So improve ROI by increasing sales or reducing variable and controllable fixed costs, which will increase our margin. So if we increase sales by 10%, sales increase $200,000, contribution margin increases $90,000, which is the 45% contribution margin rate times our change in sales. Controllable margin increases that 90,000 to 690,000. So our return on investment goes to 13.8. If we flip back to where we started, 12%. We didn't change our average operating assets. We just changed our controllable margin by increasing sales, and we increase our ROI. If we decrease variable and fixed costs 10%, total cost decreased $140,000. So our $1.1 million of variable, $300,000 of fixed times 10% is how we came up with that reduction. Our controllable margin goes from $600,000 to $740,000, and our return on investment then increases to 14.8%. The other way we can change or increase ROI is changing operating assets so that we assume that average operating assets are reduced 10% or $500,000. The average operating assets become $4,500. We haven't changed the controllable margin, and we increase our ROI to 13.3%. Okay, so this could be eliminating non-productive assets, could be, selling some assets that aren't being used, that type of thing. It could be potentially even swapping out assets. So you're getting rid of some assets, but then bringing in assets at a lower cost that maybe are newer and more efficient, so you can have the same production levels, that type of thing. Another review question. In the calculation for return on investment, the factors for controllable margin and operating assets are, respectively, controllable margin percentage and total operating assets, controllable margin dollars and average operating assets, controllable margin dollars and total assets, controllable margin percentage and average operating assets. So the calculation for ROI is our controllable margin dollars divided by our average operating assets. We'll go through another problem here. Metro Industries reported the following results for 2027. We have sales of 400,000, variable costs of 320, controllable fixed costs of 40,800, average operating assets of 280,000. Management is considering the following independent courses of action in 2028 in order to maximize the return on investment for this division. We're going to reduce average operating assets by $80,000 with no change in controllable margin. That's one option. The other option would be to increase sales $80,000 with no change in the contribution margin percentage. So what we're going to do first is compute the controllable margin and return on investment for 2027. So again, our statement would look to get controllable margin would be our sales minus our variable costs. So 400,000 minus 320, 80,000, that's our contribution margin. Then we subtract our controllable fixed costs, 40,800. That'll give us our controllable margin. Then we divide that number by our average operating assets, 280,000, to get our return on investment, 14%. So that's where we are now. If we look at our different options and what that return is, we'll see how that compares to the 14%. We're going to reduce average operating assets $80,000, not change our controllable margin. So our controllable margin is going to stay at 39,200. But our average operating assets go from 280 to 200. We see that increases ROI to 19.6%. So a 5.6% increase. Then we'll look at the other alternative, which is to increase sales 80,000, but we have the same contribution margin percentage. So our sales go from 400,000 to 480,000. Our variable costs are going to increase because we're going to have the same contribution margin percentage. And then we'll subtract our controllable fixed costs to get our controllable margin. Then we can calculate our return on investment by controllable margin divided by average operating assets. And we get 19.7% return on investment. So again, another decent increase. So both of them increase our return on investment. The option 2 increases it just a little bit more. So that would be one to pursue, but We're at 1.1% difference, so it's not a very significant difference. Now finally, our fifth learning objective, explain the difference between ROI and residual income. So most companies use ROI to evaluate investment performance. There are some disadvantages in doing that. So if we look at our calculation again on return on investment, controllable margin divided by average operating assets. This division of Pujols Company has a ROI of 20%. They're considering producing a new product, a GPS device referred to as Tracker for its boats. Operating assets will increase $2 million. Tracker is expected to generate an additional $260,000 of controllable margin. So we're going to compare this 20% return on investment to our new operating scenario. So we're going to add $260,000 to controllable margin. We're going to add $2 million to operating assets. And what we find is our return on investment actually goes down from 20% to 18%. So if we're just using return on investment, we would say it decreases, we shouldn't do it. But what we ignore is our minimum rate of return. Most companies have a minimum rate of return that they want to make sure that new projects or new investments meet. So if we assume that's 10% for this company, we should still invest in Tracker because the ROI of 13% on Tracker alone is actually more than that 10% minimum rate of return. Even though our total ROI goes down, we're meeting our minimum return on this project, so we should go ahead with it. To evaluate performance using the minimum rate of return, we use the residual income approach. So if we take our controllable margin, the $260,000 with Tracker, and then our minimum rate of return times our average operating assets, subtract that from our margin, gives us our residual income. So for Tracker, it's $60,000. If we look at without Tracker and then with Tracker, our residual income is going to increase by that $60,000. So we have a reason that we should be actually going ahead with this project because our income is going to increase by that $60,000, our residual income. It's going to be how much more income we have over our minimum rate of return. And then to evaluate performance using the minimum return, we use residual income. Here's two different scenarios. If we're using just residual income, they're the same. However, our average operating assets are increasing twice as much with CDOG versus Tracker. So we have to consider that. We are meeting our minimum return on investment, so it's a good thing there. We do have residual income. It's just going to cost more upfront to do that CDOG versus Tracker. So there's going to be a lot of different inputs when you're making a decision, but here's just two: return on investment and residual income that you can use to help guide your decision making. That's it for Chapter 10. As always, reach out if you have questions, and we'll see you soon.